My name is Max and I'm one of the advisors here at CBD Advisory. The purpose for this video is to share some of the insights that we have as a team with you, our clients, on what we feel is going to be the direction of the interest rate policy in this country. We think this information is quite topical and would benefit our clients, and we look to share this with you on three separate subjects covering Australia, the world and China. In Australia, inflation is unfortunately remaining stubbornly high, which we feel will force the Reserve Bank to put up the interest rates in the near future. We can't comment on when and by how much, but we do unfortunately feel like interest rates will be going up. That's really driven by five main factors. The first one is that consumers are simply not slowing down their spending, and that's driven itself by two key factors which are unique to Australia. Firstly, our housing market. It's on a positive note, going up. However, to curb spending, it's unfortunately going in the wrong direction to where the Reserve Bank needs it to go. Secondly, consumers have far too much savings, which have accumulated over that COVID period as a result of lenient government policies, and that spending is only now starting to be drawn, and therefore consumers aren't really slowing down how much they're spending, they're just drawing on their savings. Increased competition in the banking sector does mean that some of those interest rate increases from the Reserve Bank haven't been passed on to consumers. They've been absorbed by the banks, and therefore the full effect of the Reserve Bank's policies haven't actually been felt. Finally, our labour productivity isn't going up. In fact, it's going down, and it's one of the lowest in the Western world, which is a byproduct of our record low unemployment, which means businesses do have to outbid one another to retain staff, to hire staff. That's a higher cost, and businesses will look to pass it on to consumers. So these factors together are coming into play and seeing and causing the inflation in this country to remain stubbornly high. Inflation is unfortunately a problem not just for Australia, but the world at large. There are four major driving forces which are inflationary in nature. The first one really being the geopolitical instability that we have all seen in the recent past. Because of this instability, companies are making the decision to bring their supply chains onshore as opposed to relying on them to be in other countries. That is good for supply chain resilience, but it is bad for the cost of manufacturing, which will be going up around the world as countries bring their supply chains onshore. The second major inflationary driver is the move to greener alternative energy sources. Yes, coal, gas, and oil will still be around in the near future, but there's this massive push for countries and companies to become green, and that will require a lot of investment and a lot of costs which will be passed on to consumers. Thirdly, labour markets around the world do remain very tight, and unemployment is at record lows. Countries like China are moving to becoming developed, and their labour force is demanding higher remuneration, which does make their manufacturing more expensive. Finally, lending standards are only tightening as a result of what happened in the global financial crisis, and that does mean that the amount of lending and its cost will be going up for consumers as well as companies at large. The only positive news, disinflationary force that we see is technology, and AI specifically. It does have potential to substantially reduce costs, but that potential hasn't been seen yet or implemented sufficiently to a sufficient scale for the benefits to start flowing through. One country I did want to discuss in more detail is China, just because of its significance to the Australian economy. Australia still continues to export close to 8% of our GDP to China in the form of commodities mainly. And unfortunately, China is not immune to what is happening around the world, and it is also struggling economically. The three major trends are significant slowdown in the housing market. China, much like Australia, does have a lot of wealth tied up in residential housing, and unfortunately over the last 2 years it has come down somewhere between 30 to 25%. That is a substantial drop and has flowed onto consumer confidence, which is at record lows in China at the moment. That, together with their declining population, which has steadily fallen from around about the 1960s, but at a much faster rate than the Western world, has seen the Chinese consumer slow down their spending and demand. Why is this important? It's important because a slowdown in demand in China does impact how much commodities we do sell across to them. And if that slows and our exports slow, that will have a negative impact for the Australian economy. So what does all this information mean for you? Firstly, as an investor and a client of CBD Advisory, we do see very challenging conditions for the markets ahead, and we do see increased levels of volatility, particularly in the share markets around the world. So we are not sitting idle to this fact. We are fully aware of the challenging conditions ahead, and we will be making changes to our clients' portfolios to take some risk off the table and deploy it to other areas of the portfolio, which are historically more resilient in these conditions, such as bonds and cash. So when you do speak with us as part of an ad hoc review or your regular review meeting, do keep that in mind. If we do make changes to your portfolio, that is driven by what's happening effectively in the markets now. The second point about what this information means to you as a borrower, unfortunately, you will see the cost of your mortgages and debts go up in the near future as the Reserve Bank looks to increase the level of interest rates in the country. We do, however, encourage you to get in touch with your mortgage brokers and seek out better deals that may be available. If you don't have a mortgage broker, please reach out to us and we can put you in touch with some of the brokers that we work with. And finally, what does this information mean for you as a consumer? Unfortunately, the prices that you'll notice for everything will go up. However, in the long term, as the Reserve Bank aims to curb demand and curb inflation, those prices should stabilize and come down to an annual growth rate within the Reserve Bank's target of about 2 to 3% per year. With all that said, we do encourage for you to reach out to us if you do have any questions. We're hoping to make these videos quick, sharp, and informative and send them out on a more frequent basis and update our client base on what we think is happening in the economy or any topical news that we find. Once again, do reach out to us if you have any questions. I'm Max at CBD Advisory, and thank you for listening.